You did everything right. You didn't speed. You didn't text and drive. You didn't crash into anyone. You didn't file a single insurance claim. And yet, your car insurance just went up. No warning, no explanation. Just a higher number staring back at you like you did something wrong. If that sounds familiar, you're not alone. In fact, millions of Americans open their renewal notice every year and ask the same question: why am I being punished for something I never did? Because here's what no one tells you. Car insurance isn't priced on fairness. It's priced on prediction. And the most frustrating part? Your insurance company doesn't need an accident to raise your rates. They don't need a ticket. They don't even need a mistake. They just need data. Data about your neighborhood. Data about your car. Data about other drivers. Data about costs that have nothing to do with you. And while you're busy being a safe, responsible driver, the system is quietly recalculating how much money it can charge you. Today, we're exposing exactly why that happens. Because once you understand the real reasons your car insurance goes up even when you've never had an accident, you stop blaming yourself and you start seeing the system for what it really is. Most people believe car insurance works like a reward system. You drive safely, you follow the rules, you avoid accidents. So naturally, you expect your insurance bill to stay the same, or even go down. That belief makes sense. It feels logical, and it feels fair. But here's the uncomfortable truth. That's not how car insurance actually works in the United States. Insurance companies don't price your policy based on what you deserve. They price it based on what they think might happen next. Car insurance is not a backward-looking system, it's forward-looking. It doesn't care that you've never crashed. It cares about whether someone like you might. And someone like you isn't just about driving skill. It includes where you live, how expensive cars are to repair right now, how often other people are filing claims, how much lawsuits are costing, how inflation is reshaping the entire industry, and yes, even factors that feel completely unrelated to driving. This is why two people with the same driving record can pay wildly different prices. Same age, same car, same clean history, but one pays hundreds or even thousands more per year. Not because they're reckless, but because the system decided they're riskier on paper. And the worst part? Insurance companies almost never explain this clearly. They send a renewal notice, they raise the price, and they let you assume it's your fault. This video exists to change that. We're re-breaking down the real reasons your car insurance can go up even if you never had an accident, never filed a claim, and never done anything wrong. No math, no confusing charts, no insurance jargon. Just plain English explanations that finally make the system make sense. By the end of this video, you'll understand why being a safe driver doesn't guarantee lower rates, how other people's behavior affects your bill, why loyalty doesn't always protect you, and how insurance companies quietly raise prices without you noticing. Most importantly, you'll stop feeling confused and start feeling informed. Because once you know the rules of the game, you're no longer playing blind. Let's break it down. One of the hardest truths to accept about car insurance is this: your price is not just about you. Car insurance works on a shared risk model. That means when insurance companies calculate your premium, they're not only asking, is this person a good driver? They're also asking, what's happening to everyone else who looks like them? If accidents are rising in your state, city, or zip code, your rate can go up even if you've never touched another car. If repair costs increase nationwide, your premium goes up. If more drivers are filing claims, everyone in that risk pool helps pay for it. And right now, claims are getting more expensive than ever. Modern cars are loaded with sensors, cameras, radar systems, and computerized components. A minor fender bender that once cost $1,200 to fix can now cost $4,000 or more. A cracked bumper might involve recalibrating sensors, replacing cameras, and reprogramming systems. Insurance companies don't absorb those costs, they pass them on. On top of that, accident severity has increased. Vehicles are heavier. Traffic congestion is worse. Distracted driving is at historic highs. Even if you don't text and drive, someone else probably doesn't. Their behavior affects your rate. Then there are lawsuits. Legal settlements for injury claims have skyrocketed. Medical bills are higher. Court awards are larger. Insurance companies price all of this into future risk. So when your premium increases, it's often not because of your driving history, but because the cost of insuring everyone has gone up. This is why being a safe driver doesn't guarantee stable rates. You not just insuring yourself, you participating in a system that spreads financial risk across millions of people. Why? And that's just the first layer. Even if accidents magically stop tomorrow, your car insurance would likely still get more expensive. Why? Inflation. Car insurance is deeply tied to the cost of goods and services. When inflation rises, everything that insurance pays for becomes more expensive: repairs, labor parts, rentals, medical care, legal fees, and administrative costs. Repair shops charge more per hour. Replacement parts cost more to manufacture and ship. Supply chain disruptions delay repairs, forcing insurers to pay for longer rental car periods. Medical providers raise prices, increasing injury claim payouts. Attorneys charge higher fees, inflating legal settlements. All of this adds up. Insurance companies don't wait for losses to happen before raising prices. They adjust premiums in advance to protect themselves from future costs. That means your renewal price reflects what they expect claims to cost next year, not what they cost last year. This is why you might see your rate go up even when you didn't move, you didn't change vehicles, you didn't file claims, you didn't get tickets. Your insurer isn't reacting to your behavior, they're reacting to the economy. And here's the frustrating part. Inflation doesn't affect everyone evenly. Some states experience higher repair costs, higher medical costs, or more legal claims. If you live in one of those areas, your premiums may rise faster than the national average. Insurance companies rarely explain this clearly. They just send a new bill and let you assume it's personal. It's not. Systemic. You could be the safest driver in America and still pay more than someone with accidents simply because of where you live. Insurance pricing is heavily influenced by geography. Your zip code tells insurers a lot. Accident frequency, theft rates, vandalism claims, weather risks, traffic density, crime statistics. If claims are higher in your area, your rates go up regardless of your personal history. This means moving just a few miles can dramatically change your premium. Living near busy intersections, urban centers, or high theft areas increases risk in the insurer's eyes. Even parking on the street instead of in a garage can affect pricing. Weather plays a major role too. Hail, floods, hurricanes, wildfires, and winter storms all lead to massive claim payouts. States prone to extreme weather often experience faster rate increases even for drivers who are never personally affected. What feels unfair is actually how risk modeling works. Insurers don't assume you will have an accident, but they assume the probability is higher if others around you do. This is why people with identical cars and records can pay vastly different prices across state lines. You're not just a driver. You're a data point tied to a location. Many drivers believe staying with the same insurance company for years will earn them lower rates. In reality, loyalty can sometimes cost you more. Insurance companies often offer their best pricing to new customers, not long-term ones. Over time, some insurers slowly increase premiums, assuming customers won't bother shopping around. This practice, sometimes called price optimization, uses data to predict how likely you are to leave. If the model suggests you'll stay even after a rate hike, the increase is more likely to happen. That means being loyal doesn't guarantee rewards. Inertia can be expensive. Convenience often costs money. Some states restrict these practices, but many don't. And even where regulated, insurers still have plenty of room to adjust pricing. This is why many people only realize how much they're overpaying when they finally compare quotes. Loyalty feels responsible, but it's not always financially smart. Cars today aren't just vehicles, they're rolling computers. Advanced driver assistance systems, touchscreens, sensors, cameras, and specialized materials make modern cars safer, but also far more expensive to repair. A cracked windshield might involve recalibrating cameras. A dented bumper could require sensor replacement. Even headlights can cost thousands due to embedded technology. Insurance companies price your policy based on repair costs, replacement value, theft risk, safety technology, complexity. So even if your car feels normal, insurers may see it as higher risk financially. As car prices rise, so do total loss payouts. If your vehicle is totaled, the insurer must pay current market value, which has surged in recent years. That risk gets priced into your premium. Here's a shocker for many drivers. Not all claims show up the same way. Even inquiries, calling your insurer to ask questions, can sometimes be logged. Comprehensive claims like windshield damage may seem minor, but multiple small claims can signal higher future risk. Additionally, industry-wide data sharing allows insurers to see patterns beyond a single company. While switching insurers can help, your overall insurance history still follows you. This doesn't mean you should never file claims, but it does mean every interaction has potential pricing consequences. Insurance rewards low usage, not just safe driving. The biggest takeaway is this: rate increases are rarely personal. They're driven by data, predictions, and profit protection, not fairness. But once you understand how the system works, you can respond strategically. Shop rates regularly, review coverage annually. Adjust deductibles wisely, bundle policies when possible, maintain strong credit where legally allowed. Knowledge doesn't stop rate increases, but it prevents you from overpaying silently. If your car insurance has ever gone up and made you feel confused, frustrated, or blamed for something you didn't do, you're not crazy. The system isn't built to explain itself. It's built to calculate risk quietly. But now, you understand the real reasons behind those increases, and that understanding gives you power. If this video helped you see car insurance differently, subscribe for more clear, honest breakdowns. Like this video so others can find it. Comment below with any questions, you'll get real answers. This is InsureBetware. Insurance finally makes sense.